What if I told you that one of the world's largest companies went bankrupt overnight? Imagine an energy titan, Enron, lighting up homes and businesses across the globe, a symbol of power and prosperity. Its ascent was meteoric, its influence undeniable. Yet in the blink of an eye it crumbled, its brilliance extinguished. An unexpected collapse that left many questioning. How could a company worth billions vanish into thin air? Let's unravel this mystery. Before we delve into the complex web of deceit spun by Enron, let's take a moment to appreciate the sheer scale of its rise. This energy behemoth, once the seventh largest company in the United States, began as a humble pipeline company in the 1980s. Through a series of strategic acquisitions and bold ventures into new markets, Enron rapidly expanded its reach. It wasn't just an energy company anymore, it became a pioneer in energy trading, creating markets for a wide variety of commodities including broadband, weather derivatives, and even advertising time. Its profits soared, its influence grew, and Enron was hailed as a symbol of corporate success. However, behind this dazzling display of prosperity, a storm was brewing. A storm that would bring this titan of industry to its knees. As we peel back the layers of Enron's success, we begin to see the early signs of its impending downfall and the intricate web of deceit that would ultimately pull the company under. As we delve deeper into the Enron saga, we uncover the dark side of the story. The most infamous corporate collapses in history involved several complex accounting tricks that allowed the company to hide its mounting debts and inflate its profits. Firstly, Enron employed mark-to-market accounting. This method allowed them to record potential future profits on the day a deal was signed, regardless of whether those profits were ever realized. Secondly, they used special purpose entities, or SPEs. These were shell companies created to hide debt off Enron's balance sheet, making the company appear more profitable than it was. Then came prepay transactions. These were essentially loans disguised as revenue. Enron would receive cash from a bank and in return agree to deliver goods or services at a later date. Enron also devised Raptor vehicles, also known as LJM partnerships. These entities were used to hedge assets on Enron's books and to keep massive amounts of debt off the company's financial statements. Furthermore, Enron inflated revenue with round-trip trades. These were essentially simultaneous buys and sells of energy with the same counterparty at the same price, creating the illusion of high trade volumes. Lastly, the excessive executive compensation. Enron's top executives were receiving massive salaries, bonuses, and stock options, even as the company was spiraling towards bankruptcy. These manipulations, which ultimately led to Enron's downfall, were a masterclass in deception and manipulation. Stay tuned as we explore the rise and fall of this once revered titan. The fall of Enron was as dramatic as its rise. The year was 2001 when the financial facade began to crumble. Accounting irregularities were discovered, hinting at a much larger, more sinister operation beneath the surface. Enron's auditing firm, Arthur Andersen, was pulled into the vortex. They were accused of assisting Enron in manipulating financial reports, creating an illusion of prosperity. The stakes were high and the investigations were relentless. As the truth unfolded, the impact was devastating. Shareholders were left in the lurch, their investments in Enron worthless. Employees, the backbone of the company, faced the harsh reality of job loss, their retirement funds tied up in now worthless Enron stock. Enron, once a symbol of innovation and success, was now a synonym for corporate greed and deception. The fall was swift, the repercussions far-reaching. In the end, Enron's empire was built on a foundation of lies. The Enron scandal sent shockwaves through the business world. It led to an unignorable upheaval, demanding a stern reckoning. The company's top executives faced severe legal consequences, with many serving substantial prison terms for their roles in the fraud. The aftermath also led to significant regulatory changes. The Sarbanes-Oxley Act was enacted, providing a stronger framework for corporate governance, financial reporting, and audit procedures. This act aimed to protect shareholders and the general public from accounting errors and fraudulent practices in enterprises. It was a clear signal that such egregious corporate misconduct would not be tolerated. The Enron scandal serves as a stark reminder of the devastating consequences of corporate greed and lack of oversight.